Most investors focus on returns, but overlook the silent force that decides how much wealth they actually keep. Taxes quietly shape outcomes long before profits are realized. Two investors can earn the same returns, yet end up with very different results based purely on tax decisions. Understanding tax planning is not about loopholes or shortcuts. It is about structure, timing, and awareness. In this video, you will learn how basic tax planning protects growth and preserves long-term wealth. Like and subscribe to continue learning how smart systems quietly outperform raw effort. 1. Why taxes matter more than most investors realize. Taxes directly reduce investment returns, yet many investors treat them as an afterthought. Every gain, interest payment, or distribution interacts with tax rules that determine how much is kept versus lost. Over time, these small reductions compound into large differences. Ignoring taxes is equivalent to accepting lower performance without question. Smart investors view tax planning as part of the investment process rather than a separate task. By understanding how different investments are taxed, they align strategy with long-term efficiency instead of reacting at the end of the year. 2. The difference between gross returns and net returns. Gross returns represent what an investment earns before taxes. Net returns show what remains after taxes are paid. Wealth is built on net results, not headline performance. Two strategies with similar gross returns can produce vastly different outcomes once taxes are applied. Tax planning focuses on maximizing what stays invested. This means considering holding periods, account types, and income classification. Investors who track net performance make clearer decisions and avoid strategies that look attractive on paper but underperform after taxes. 3. Understanding taxable and tax-advantaged accounts. Where an investment is held can be as important as what is invested. Taxable accounts generate ongoing tax obligations, while tax-advantaged accounts allow growth with reduced friction. Placing the right assets in the right accounts improves efficiency without changing risk. Long-term growth assets often benefit from tax-deferred environments, while income-producing assets require careful placement. Account structure acts as a silent multiplier when aligned correctly. Poor placement creates unnecessary drag on performance. 4. Timing of buying and selling decisions. Taxes are often triggered by selling assets. Timing these decisions influences how much tax is owed. Holding investments longer can reduce tax impact, while frequent trading increases it. Strategic timing aligns transactions with long-term goals rather than short-term emotion. Investors who plan exits consider tax consequences alongside market conditions. This approach reduces surprise liabilities and improves consistency. Timing is not about predicting markets. It is about coordinating decisions with tax efficiency. 5. Capital gains and holding periods. How long an asset is held affects how it is taxed. Longer holding periods often result in more favorable treatment. Short-term trading increases tax burden and reduces compounding potential. Understanding holding periods encourages patience and discourages unnecessary turnover. This aligns naturally with long-term investing principles. Tax planning reinforces disciplined behavior by rewarding time and consistency rather than constant activity. 6. Income from investments and its tax impact. Some investments generate regular income through interest or distributions. This income is often taxed differently from long-term growth. High-income investments may create steady cash flow, but also ongoing tax obligations. Investors must balance income needs with tax efficiency. Understanding how income is treated prevents surprises and allows better planning. Income strategies should support long-term goals rather than undermine them through excessive tax drag. 7. Using losses strategically. Losses are an unavoidable part of investing, but they can serve a purpose. When used strategically, losses can offset gains and reduce overall tax impact. This process requires discipline and record keeping. Strategic loss use does not mean chasing losses or selling quality assets impulsively. It means recognizing that setbacks can be integrated into a broader plan. Investors who understand this reduce the emotional weight of losses and maintain focus on long-term outcomes. 8. Rebalancing with tax awareness. Rebalancing maintains alignment between a portfolio and its intended risk level. However, rebalancing can trigger taxes if done without planning. Tax-aware rebalancing considers which assets to adjust and when. Using contributions or tax-advantaged accounts can reduce tax impact. This approach preserves structure while minimizing friction. Effective rebalancing balances discipline with efficiency rather than reacting mechanically. 9. Avoiding common tax planning mistakes. Many investors unintentionally increase taxes through frequent trading, poor account placement, and lack of long-term planning. These mistakes are rarely dramatic, but they accumulate quietly. Awareness is the first defense. Simple adjustments often produce meaningful improvements over time. Avoiding unnecessary complexity also reduces errors. Basic tax planning is about clarity, consistency, and alignment, not aggressive tactics. 10. Tax planning as a long-term system. Tax planning is not a one-time action. It is an ongoing system integrated into investing decisions. As income grows and portfolios evolve, tax considerations become more important. A system-based approach adapts over time without constant intervention. Investors who build tax awareness into their strategy protect compounding and preserve flexibility. Over decades, this system quietly strengthens outcomes and reduces avoidable losses. Successful investing is not only about what you earn, but about what you keep. Taxes quietly influence every decision and every outcome over time. By understanding basic tax planning, investors protect growth, reduce friction, and build more resilient portfolios. Small adjustments today create meaningful differences tomorrow. Like and subscribe to keep learning how smart financial systems turn ordinary investing into long-term wealth.